IC, ROIC, CROIC. The figures behind these cryptic abbreviations will tell you how effective a business invests its capital. In this video of the 3-minute short video series, I give you a quick introduction on what they mean, how they support you with investing in stocks, and how you use them. Hi, my name is Till, and this is the channel that shows you how to invest intelligently and easily, and how you build up a fortune also as an ordinary person with a normal job. When you're new here, hit the subscribe button and ring the little bell for not missing any new videos. So let's start the 3 minutes. IC. The IC in IC, ROIC and CROIC means invested capital. When a company requires capital for operating its business, it can generate this basically in 3 ways. It can sell stocks to shareholders, it can issue bonds to debt holders, and it can ask a bank for a credit. The problem with invested capital is one which actually relevant financial figures like free cash flow and invested capital both have. You cannot directly find and read them in the financial statements. You will have to calculate them on your own. But don't worry, this is easy. You take the short-term debt, you add the long-term debt, plus the shareholders' equity. ROIC. ROIC means return on invested capital. It is a figure that is supposed to measure how well a company employs its invested capital to generate profits. The higher the figure, the better the ROIC. It is calculated by taking the net income and dividing it by the invested capital. Why is this important? Some businesses require more capital than others. The automobile industry or the airplane industry, for example, need to invest lots of money to generate their profits. They have to invest in lots of tooling, machines, assembly lines, etc. Usually they have quite low returns on invested capital. Software companies or also internet companies don't need that much capital. They mainly need people and computers. Once a software product is developed, it can be copied at low costs compared to the selling price, or it will today just be distributed via download. And some companies apply their invested capital simply better than others. So it is worthwhile to have a look into this before you decide to invest in a company. CROIC. CROIC means cash return on invested capital. If you have seen the video on free cash flow already, you know by now that net income is an unreliable figure as it is created for the tax report, but not for the shareholders. And you know that free cash flow is a much better figure for evaluating a business. As ROIC is based on net income, it is also based on a figure for the tax report and therefore not that reliable for shareholders. But there is an alternative, CROIC. This is basically very similar to ROIC and is also measuring the ability of a business of using its capital. But instead of net income, it uses the more reliable free cash flow as the basis for the calculation. As for ROIC, the higher the number, the better.